All right, good afternoon, everyone. I am an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure. I am out of Snap and Palantir into the up moves today. They got to my targets. I have a new position on in GameStop, believe it or not. And I got involved in some of these Peloton calls based on some of the large order option flow that we're seeing today. Happy to discuss. We have Palantir just reported. Palantir is trading down a little bit from where it closed on what looks like a pretty decent report, but it was up massive today on expectations that they were going to have a pretty decent report. So the numbers look good, but not mind-blowing. So I'm not surprised to see it trading down from where it closed today. I would almost expect it to actually be down even a little bit more if you attribute the intraday up move today entirely to. There was an article on Seeking Alpha this morning. I didn't read it, but I read a headline of the headline that said that it mentioned Wedbush and that there was a mention that the earnings report tonight is going to be really good and better than expectations. So they really ripped Palantir up today. They gapped it up to almost $24. They closed it at 25 quarter, and now this report is out. And again, it's good. Second quarter revenue guidance is a nice little beat, $5 to $10 million or so, a little more than that actually. Palantir Q1 adjusted EBITDA beat by about 30 million. Palantir Q1 rev beat pretty nicely. Maybe 20 million or so there. Palantir Q1 adjusted EPS 8 cents versus expectations of $7.09. Some good language out of their report here as well on focusing on artificial intelligence, yada yada. So yeah, pretty good report. But again, they really rallied it a lot today into that. So a move back that kind of fills today's gap to like 23.50 or so makes sense. We just got there. We just put in a low at 23.40. Could have nibbled on a little bit there. I didn't. I'm going to be patient for now. I do have a bid out in Palantir that's pretty deep out of the money from even where I'm trading right now. Probably won't get there, but we'll see. What else? So the market was strong today. Let's talk about it. Let's jump into our meeting. So SPYs here up a percentage point and down a little bit from where they closed. Q's up a percentage point, also down a little bit from where they closed. And the IWM up about 1.2% and also down a little bit from where it closed. Really, really strong day today for the market. And that was kind of the thought process coming into today's trading session. We wanted to see if we could get above this key SPY 515. And we did. We got above it. We closed above it. The market seems really bullish to me after what happened the second half of last week, which is now being totally confirmed by the technicals as the SPYs are getting above 515. And that was kind of the chatter that we had today in the morning meeting. Pat's note was just really solid this morning. I was able to take some things out of it and some things. One of the cool things about Pat's note is that sometimes I've got ideas kind of floating around in my brain, and then I just will read those ideas actually, which helps me to confirm my thesis, but also I'm able to read in some ways my own thoughts in a little bit more of a concise way. And I mentioned in the morning meeting, but I just really liked this line here. It's so simple. Market pricing for the Fed trajectory tends to overshoot. It's as simple as that. And I mean that sums up what we have really seen here over the course of the last couple of years as far as perfect example being the market pricing in 175 basis points worth of cuts as the year started, which we were saying as a team it's ridiculous at that time, completely ridiculous. And in the beginning of the year, one of my biggest worries about the equity market was that as that pricing of the Fed trajectory normalized a little bit to, probably 3 cuts, which is at the beginning of the year what the Fed was actually saying, that it could have a major negative impact on the market. And one of the most amazing things about this entire calendar year has just been how incredibly well the market has actually held up in the face of that repricing. And now the question that I was starting to ask myself for pretty much most of last week was, now did we swing our pendulum the complete other way here, where the market, especially when, prior to the Fed day on Wednesday, when we started seeing chatter about hikes coming out this year. And then to me, that was blowing my mind in the opposite way. The same way that 175 basis points of cuts was just blowing my mind as completely unrealistic in the beginning of the year. The probability of hikes that started to get chatted about at a certain point last week was also blowing my mind as just relatively unrealistic and completely contrary to everything that the Fed has been saying. And then Jerome Powell, as we know, on Wednesday last week did a fantastic job basically letting everyone know that there is going to be no hikes. And now the market, which had seemed to price in almost peak hawkishness, and again that pendulum swung the other way, is now normalizing again here a little bit. But the interesting part is that you take all that information and then you combine it with the CTA information that's coming from this Bank of America note that talks about how there's a potential of a short squeeze basically in treasuries on these CTAs if it continues higher. So that's got me like, this is interesting. The market seems like it overpriced in the hawkishness. So we start to see a little bit of a bid coming into TLT and into treasuries at the end of last week, which helped this market to be particularly strong at the end of last week. But the data is also showing, and again, keep in mind that the treasury market is insanely massive, but the data is also showing that could lead to a potential feedback cycle of buying leading to more buying for treasuries, which in turn, at least in the short time frame, brings interest rates down. And if that were to happen, I would expect that our most interest rate sensitive areas of the equity market would catch the biggest bids on it, which, I mentioned just a minute ago here that one of the most impressive parts to me of 2024 has been that the market was able to reprice 175 basis points worth of cuts down to 29 basis points worth of cuts over the course of whatever it is, 4 months, 5 months. Yet the equity market never really pulled back at all. That's not necessarily true when you dig in a little bit deeper and you look at the more interest rate sensitive parts of the market. We know that at certain points this year, even though I would still argue that the IWM has held in actually really well given the amount of reduction in cuts or increase in interest rates over the course of this year. But obviously we know that the IWM has been relatively weak. This was a very big pullback in the Russell. I forget what the percentage was, from 212 down to 191, like working towards market correction territory. But really, if you look at the certain segments of the world that are these growth long duration stocks, and ARK actually held in okay compared to some of them, that's where you'll really see the weakness. I mean, ARK ended last year above 52, put in a low a couple weeks ago at 41.50. So, ARK is in a bear market, a new bear market in 2024. And if you just type up the average growth stock that you look at, you'll find that many of them are down between 20 and 50% on the year. And that makes a lot of sense for a couple of reasons. One is that these had the biggest moves in November and December when the market was working its way towards the potential of 125 basis points worth of cuts. So they had the biggest up move, they had the biggest down move, whatever. The most, these names are super high beta. We all know that. But now I'm wondering, coming into today, with the entire market, if the entire market can get even further supported, if we begin to see a further squeeze up in treasuries, if the thing I was looking for today was if TLT could hold above $90, and particularly I would look to the growth segments of the market for that squeeze higher. Again, the things that are most beaten up. I'm not going to come out and say I'm a Kathy Wood bull. I'm definitely not going to do that. We know that I think but I'm not going to come out and say that I'm a Kathy Wood bull. But it's so interesting how markets work, isn't it? So Kathy's ETF, we know, has created like more dollar for dollar shareholder destruction than I think any non-leveraged ETF in history. I think that's the quote that we're up to with her ETF here. But and while her performance from highs is obviously atrocious, I mean, this ETF has had a pullback from $160 down to it's currently trading at 46. A large part of the reason why this ETF has created more dollar shareholder destruction than anything else goes back to human psychology and human nature. It's because I wish that I had access to a chart that could show you like the chart of ARC in conjunction with the chart of the growth of assets under management. Because if you were involved in ARC from the very beginning, I mean, look, there's still a decent little performance here. Even if you go back to 2017, this was a $23 ETF, and now it's trading at $46. It's 100%. Not comparing it to the market, but just outright, that's a 100% movement. But the reason why this has created so much destruction is because if you could see a chart, and I don't know this for sure, but I'm pretty confident of it, if you could see a chart of the accumulation of assets, well, when was everybody buying ARC? They were buying it, here. They're buying it at $100 plus. So, I'd be curious to know what the average price is of the average holder of people who are involved in ARC. And now all of a sudden, what are we finally beginning to see? In the same way that this was the most euphoric thing in the world at highs, now is when all the articles are coming out about how it's created more shareholder destruction than anything else. And even more importantly than that, data is showing that while for a long time ARC holders actually did a pretty good job on the way down, or maybe a bad job of risk management. On the one hand, you could say it's a bad job of risk management, or a good job of not just completely puking out. There was a lot of interesting data that showed that the ARC shareholders, she wasn't losing assets under management in really pretty much anywhere within this down move. And now the data is showing that she finally has started to really, over the course of this year, bleed out AUM. So I don't know. I just think that when you look at, and it's really the same thing even with most hedge funds. It's been a problem with big hedge funds forever. I mean, you take a look at like real tail risk hedge funds. Most of them accumulated the most amount of assets that they've ever seen at like the 2009 bottom, and then right as you might need that tail risk hedge part of your portfolio by having money in those types of funds, probably when you need it the most is probably when the market's had a fantastic move and it's beginning to bleed out. So it's just interesting to me that now that we're seeing 2024 as growth is the most beaten up area, ARC is underperformed. ARC is losing assets. All these articles are starting to come out about how much shareholder destruction she's created. Just as you're seeing that is when I'm starting to look at an environment that is maybe potentially beginning to actually set up to squeeze these names again. You'll see that if this TLT can continue to rise. You're already seeing it in certain individual names. Obviously, if you look at our Carvana or a Wayfair, last few days in Wayfair since that earnings report have been incredible. But now, what are we seeing today in the last few days? Like GME waking up again. Ton of option flow over the course of the last several trading sessions, including some continued flow today in GameStop that's waking up. I mean, you could really see the potential. I don't think it's going to be at like the end of 2020 or beginning of 2021, But you could see that this area of the market, which again is primarily, if you're not looking at Carvana, very beaten up on the year. I mean, I don't know. Look at like a Unity this year that's worked its way down from 42 to 22, and now it's bounced a few bucks. Or AI has worked its way. I guess there was this one spike here, but for the most part, this AI was $30, worked its way down to $20, and I would argue that this actually didn't even participate in the up move as big as some of the other ones did. Or BYON, which has earnings, I think, at a weird time tonight at like 7 p.m. or something. But here's another one. Look at this move just over the course of the last month. Worked its way down from 36 to under 20. So there's room for these names to bounce, and you've got a potential cross-current effect of TLT, if this squeezes higher, giving interest rate relief, which would positively impact the most beaten up sector of the market for this year, which is the most interest rate sensitive sector, which is these growth stocks, right as the sentiment on them has gotten kind of max bearish. So it has me liking those names, and I'm going to continue to keep an eye on those names to see if they can really squeeze further here, and certainly pay attention to the TLT, because like I was saying, TLT should give the most amount of relative strength if this thing rallies to the IWM, to these growth stocks, but I think it'll move the entire market. I think it'll squeeze the entire market back up as well. And we're starting to get confirmation there. So the big game plan for today was, hey, let's see if TLT, which was trading above 90 pre-market but was below 90 by the time the market opened, if this thing can get above 90, if we can get further relief there. Let's see if this SPY can get above 515. 515, I've been saying for a couple weeks on a closing basis, I think is your real confirmation that bulls have now fully regained control from this 5% plus market dip that we had, and we're back above it now. We've negated this really important negative Maribozu from April 15th. The concerns out there are one, as far as even today's trading session goes, it did feel like you were chasing a little bit. There was a healthy amount, not extreme upside extension, but a healthy amount of upside extension in the SPYs and the Qs away from the ADMA as of this morning, which gave me some pause. And at the same time, I was taking pause because the TLT pre-market traded back below 90 and traded flat for most of the trading session before in the afternoon it finally broke up and got back above. So we were kind of in this no man's land of extension. And while the SPYs have gotten above that 515, the Qs haven't fully confirmed it yet. They got to get above 442. But the Qs as of the close today are $9 extended. So obviously the ADMA will be a little bit higher tomorrow, so we won't be at extreme extension. But if we're up to, and I'm guessing I'll be able to assess it better in the morning, if we get up to 443, I would say tomorrow in the Qs, which would be a move that was less than today's move, then we would probably be at extreme upside extension in the Qs. But it's also right as the market's finally confirming that we're back into full bull mode territory, right? So a lot of times we have to balance a market that's bullish with a market that is moderately to extremely extended, and what that means from a trading perspective. It's funny because there is a potential that tomorrow, right as for the first time since we broke down, for the first time in a month, right as we really have confirmation that the market's becoming bullish, might at the same time be the same point where the market's hitting extreme extension, where you actually might even want to consider cute shorts instead of buying a market that's now confirming bullishness, if that makes any sense. So yeah, really interesting market. I do think that positioning and sentiment, and we were saying this last week, it hit a point where if we could get a catalyst to the upside of the market, the peak hawkishness needs to get unwound a little bit, and that could bring the bull market kind of back to life. That really seems to be what we're seeing between the Fed on Wednesday, Apple Thursday night, and that jobs report actually coming in a little bit weak on Friday. It's bringing these cuts back on the table. I don't think they were ever off the table, but it's bringing them back on the table. And, the market is becoming bullish as it absolutely should be. So that's kind of where we're at from a big picture. On the small picture, again, like I was just kind of saying, not to overly repeat myself, but you always got to pay attention to extension on the small picture. So whereas this morning I was feeling pretty bullish, I also had to take a little pause when I was seeing, yeah, but we got $7 of extension from the ADM and the Qs, which is no man's land from risk reward. And the TLT at that point was flat, so I wasn't getting really confirmation of my thesis. Obviously, the TLT woke up, and when the TLT did wake up, it helped the market to kind of break out of the intraday range that it spent most of the day in as well. There were still, individual names that were worth looking at today that gave some decent trades, though. So hopefully, you guys were involved in them. That's pretty much all that I've got. GameStop was a good trade today. We're seeing a lot of dated out Palantir flow, which I still have a little bit of a position in from when I made a mistake last week, so I honestly probably shouldn't be in it, but I've got a little bit of a position in it, but it also had me buy some of those options just in case. I've been saying it for a long time, and it hasn't happened, but I do think that there still is the possibility of a Peloton buyout. I'd be surprised if this thing actually went bankrupt before someone bought it. And it's trading right before this move here the last couple 2 days ago on the earnings report, I think that ticked to new all-time lows. So at a certain point here, I think that there is a floor, and yeah, it's all-time lows. At a certain point, I do think that there's a floor in here with a potential of a buyout, though I think I said the exact same thing at one point on the way down when it was at like 20. So we'll see how that plays out. But got to pay attention to that unusual option flow sometime. I mean, it's just been too often that we've seen consistent option flow that's a little unusual, and then all of a sudden something happens. So maybe something will happen, or maybe nothing will happen. So that is all that I've got. I am happy to work through any questions or comments or anything that you guys may have. Starting with Rex. I was looking for ARM this morning through 105. That was one of the ideas that we had discussed in the morning meeting today. Looking ARM through 105. A little extended on that first candle when it goes through it, but the idea worked. I didn't take the trade at 935 when it broke 105, basically because of the market extension off the open. So you got the market extended, you got the stock extended. I'm totally cool with you being patient. I waited until 10:15 to take my long when it touched the ADMA on the 5 and it pivoted back up. Okay. I also saw the volume increasing when it ticks back up above 106 with the Qs trying to tail back up as well. So I put my stop in at that bar low, but then I got shaken out on the trade. Do you think I had the right execution, or I got into the trade too early because obviously that 12.25 candle also gives a hammer with higher volume, which would convince me more. Yeah, so I like going after ARM today. I get the struggle of buying it in the beginning of the day because of the extension. You're buying this thing through 105, which is the price level that we discussed in the morning meeting, in the first 5 minutes of the day, when you have a very extended market, and the stock itself is also very extended. So you could have taken that trade. It just wouldn't have been. It would have been a pure momentum trade, and there would have been a lot of risk. You're risking $1.40 on a pure Momo trade at that point is tricky when you've got. Again, this is the difficulty of a market that is $7 extended from the ADMA, is that you're just kind of in no man's land with a lot of things. So inherently it makes your risk reward worse on a lot of trades that you might come up with throughout that day. And the risk reward here is tricky for a pure momentum trade to risk $1.40 on a $105 stock. I like this little pivot low here at 945 as well, but you kind of have the same problem. ADMA and the 5 still isn't caught up. Market's very extended. So finally you go for it here at 10:15, but what do we know at about 10:15 is when your 15-minute chart becomes even more important than the 5. So to me, in some ways, this buy off the 10:15 candle low is very similar to buying off the 945 candle low. The 945 candle low, you're trying to buy a pivot when you've got 5-minute extension. At the 10:15 low, you're trying to buy a pivot when you've got 15-minute extension. It's almost kind of same. Like, I know you're not extended on the 5, but again, at 10:15, the 15 matters more than the 5. So all of these spots would give you at least some degree of pause, I think, from an extension perspective, whether it's the one that you took, or it's the opening trade, or it's that other pivot that's a little earlier in the day at 9:45 here. So they never, I think, made it easy. I don't hate your trade. You just got to realize that you're still kind of taking a momentum trade, just more like 15-minute momentum, which in some ways I dislike even more than 5-minute momentum. 5-minute momentum in the first half hour of the day, you can get it. It's pretty easy for an extended stock to become even more extended. I think when you get into that 10:15, 10:30 period, it becomes even more difficult to get momentum unless new news is actually hitting the stock or hitting the market. So it strikes me as a tricky trade, but I wouldn't say that the execution on it is wrong. I just, it's always about layers of probability. And when you're buying something that's extended, what does that mean? You have a higher inherent probability of getting shaken out in your trade even working, let alone your trade even failing. And that seems to be what happened. You got shaken out of a trade that eventually works, the pivot's a little bit deeper, it's 10 minutes later in time, and then it goes. Honestly, at the 10:25 pivot low, you got the same problem at the 10:15 pivot low. It's just a little bit less of a problem because it's a little bit less extended by that point on the 15, and you got a little bit more volume confirmation. So I wouldn't characterize any of these opportunities in ARM today, the 3 that worked or the one that you were involved in that happened to be the one that didn't, as A+ trades by any means. They're all solid B minus trades. I don't hate being involved in any of them, but I probably wouldn't be going full risk on any of them either. So hope that helps, Rex. Appreciate the question. From Rock, when do CTAs buy back the stock that they sold? I think in an up tape, which we're having right now, they're already in the process of rebuying it. And I think in an up to flat tape, this is just the data that we saw, which might be a little bit stale now. I think it's about a week old. As long as the market doesn't go into a decline, I think CTAs are a buyer in flat to up tapes and have the capacity over the month of May, again, unless the market's in a decline, to buy back everything that they had sold over the course of April. So I do think that from an equity perspective, our flow is positive for the market as well and could get further juiced if there's a squeeze on treasuries. Thanks, Rock. From Q-Sang asking me for thoughts on Guild. Wow. Oof, I don't look at this name very much. This thing is smoked. Biotech, and I don't know if this is in XBI. I'm pretty sure it's in BI. What's the other one? I'm blanking on it. Not XBI. Someone help me out. Not XLV. IBB. I'm pretty sure Guild's in IBB. But yeah, I haven't looked at this in a while. I mean, this is another area of the market, and I don't know the company's business super well, but this is another type of name that I think should be able to perform in any environment where you're seeing the TLT continue to move higher and interest rates come down a little bit. So I like the idea of keeping it on the radar. I like the snapback that it had today, but you also have to recognize that this thing is in a clear, nasty downtrend. It seems like an orderly downtrend, and you're just running into the declining moving averages. It's always difficult to buy weak stocks into declining moving averages. But so I don't like that idea technically, but more from a thesis level with what I was saying about some of the most beaten up stocks out there catching a bid. If we can see some relief on interest rates, which I think is a possibility, then I like the idea of looking at Guild here for long entries. So hope that helps, Q-Sang. Thanks for the question. From Vikas on Netflix. Wow, Netflix almost filled the gap today. That's a sick move. What did Meta do? Because Meta's the other chart that I thought was a little nasty from the gap down post earnings. Not as strong as Netflix. What did I just lose this last candle? There it is. So Netflix is a little bit tricky. So I know you're gonna ask me something. I haven't read it yet on this. That's probably related to more of the small time frame. But whenever I look at anything on the small time frame, I always have to start with the big time frame because the big time frame I like to say tells me what to do, and the small time frame tells me how to do it. So for me, Netflix is definitely concerning because it's been weeks since the earnings report, but there is a big gap there, and you've got clear resistance of that gap at 580, and your 21 EMA is also in that low 580 area. So there is decent resistance around 580. But if it can clear above those low 580s, then you're entering into a really big gap, and you have the possibility for this thing to flow fairly easily into a gap fill that's up to 605. So what I would say on the big picture, which again I always need to start on this big picture before I look at, tell me what I want to do before I figure out how I want to do it. And the what I want to do is I don't want to be long this thing below 580. I potentially want to be short this thing below 580, especially if I have market concerns. But if it can break above 580 resistance, then I would want to look to see if this thing can squeeze for more of a gap fill. So broadly, I'm willing to be long above 580. I don't want to touch it below 580. So that's my what I want to do. And now we need to look for the small time frame on how we want to do it. So the stock here gaps to above 580 today, right? Yeah, opens almost at 582. The opening low is 580.25, so retests and holds it perfect. Now let me reread the rest of your question. I bought Netflix at 586. Okay. So somewhere post 10 a.m. 10 to 10:30 it looks like. I closed it at 590. Okay. It's an okay move potentially. Depends on what your risk was. $4. I should have held longer. It just kept rising. There's no should haves in trading. It's another one of my favorite sayings. Thoughts on a better system to close out, stay in. I figured no catalyst, so why risk it? My stop was at 582. So you risked $4 to make $4. I don't like that as kind of a general rule. If you're going to be risking $4 to make $4, and I'm assuming that you did that on your entire position because you really just liquidated your position at 1-to-1 on your risk, that means that you have to have a probability of success that's better than 50% in order for you to be a consistently profitable trader. Almost all of the best traders I've ever met have a success rate that's below 50%, and therefore need the risk reward to be significantly more than that in order to be consistently profitable. I do know I have met very few, literally I could count on one hand, traders who can be consistently profitable and make 1-to-1 fairly regularly with what they do and have a success rate that's greater than 50%. Maybe you're in that camp with your strategy and your approach. I don't know your trading strategies and approach well enough to be able to answer that question. But again, it's something to keep in mind. And I would say very broadly, just based on overall success I've seen from traders over the years, I really don't like the idea of risking $4 to make $4 on trades. I don't know if that will breed consistent profitability in the long run. So your stop was 582. I'd love to know why you picked that as a stop loss. I don't see it as any sort of important tail or low or anything like that in the stock. If you bought at 586 and you didn't timestamp that for me, let's just assume it's the first time it gets to 586. Basically, it has to be either the 1005 or 1010 candle because that's the only time it ever hit those prices. I'd be looking to utilize stops that are initially based on that smaller time frame. So, your only real reference points at that point are this last pivot low that happened at 955, which is 583.05. Look to get in at 957, 1 minute candle. Okay. So yes, still would want some feedback on how you chose that 582 as a stop loss. I just don't see anything, and I don't even have a 1 minute chart to reference. I can get into 1 minute charts in a second, in my opinion on them. But based on the 5 minute chart, you've got a reference point as a pivot low here where the EDMA caught up to it. That's at 583.04 that you could use as a stop loss. Outside of that, you've got the 940 candle, which is 580.84, or the low of the day. So that's important spots on the 5-minute chart. On the 15-minute chart, there's nothing. On the 15-minute chart, there's nothing except the low of the day. So your only potential stop loss on the 15-minute chart there is going to be the low of the day. So I would want my stop losses to be based on the message of the market more than just kind of a random price that I'm comfortable with, a certain amount of risk. I like pivot lows because, for example, this low here at 9:55 a.m., which is at $583.05, that spot is the spot where buyers regain control from sellers, right? You know that there's like a 7-minute period here from the pivot low at 9:40 to the absolute high at 9:45 where buyers are in control. How do you know? Because the stock went up. Well, what happened at that high? Even if it's at a very small time frame, sellers took control and they drove it down to this low. And what happened at that low, which again, this is my reference point, 583.05, that's the spot where buyers regained control from sellers and then drove this up to new highs. That makes that spot actually important in a dynamic of buyers and sellers in a marketplace. That's a spot where buyers took control from sellers. So if they were to lose that spot, you know that something is wrong and that the idea itself is wrong. So that would be the first thing I would say is on the stop loss, the initial stop loss for how you're managing risk. The second part is the reward side. I'm seeing that you're saying that you were shooting for, meaning you had a target of $596. So $596 would mean that you'd be risking $10. Sorry, you'd be risking $4 for a potential reward of 10. So now you're at 2.5 to 1, a little bit better. I like that a little bit better. I can live with that. I still honestly would like a little bit more. Looking for 3x, looking for 5x, looking for 10x. So I like that a little bit more. But now the next part of your thought process. So now if you're trading in the way that I view as correct trading, when you are entering this position at 586, you have a game plan. And your game plan is, I'm shooting for 596. I'm looking for $10 worth of reward. That's a game plan. And you've got a stop loss. Even if it's a stop loss that I don't personally agree with from a thought process perspective, it's 582. So now you have a game plan in place for your trade. The trade starts to work out. You're $4 in the money. You go, oh man, the stock's looking good here. I'm $4 in the money. Why, you keep saying, why risk it? Why risk giving it back? Because I'll tell you why I risk giving it back. Because it wasn't worth being in the trade to begin with if you're just going to get out for $4 worth of reward. That's why I risk it. Because in the long run of trading, if every time you have a game plan that calls for making $10 worth of reward or X amount worth of reward, and that's the reason that you're taking it, but you liquidate your position because you have new thought processes that are coming into your head as you're taking that trade, that say, you know what, why risk it? I'm just going to take this profit and run. You will find ways to be able to talk yourself out of almost any trade that you get yourself involved in. I could just about guarantee that for any trade that I'm in or for any trade that you take, I could probably come up with, if I really tried, one reason why it should fail. And then from a psychology perspective, when we're in the money or out of the money or whatever on our positions, when the trade is ongoing, it can become very easy to overly focus on the one reason why it should fail for the 99 reasons why it shouldn't. If you're saying that, why risk it? There wasn't a catalyst to begin with. Well, guess what? You knew that there wasn't a catalyst when you took the trade to begin with. So if that's the thought process, I would harken back to, you never should have gotten in the trade to begin with. If you don't have all of your layers of probability, if you need a catalyst in order for you to come in to risk $4 in order to think that you can make $10, and the catalyst isn't there, either you shouldn't take the trade at all to begin with, or you should take the trade because you're deciding to take the trade and then actually let that trade play out in order to, maximize your reward on your trades. Traders in this business tend to have two main problems. The primary one of them, this is the bigger one for more people, obviously, again, there's two main problems. The bigger one for more people is that they don't manage risk properly on the downside. The same way that you had a game plan in place to look for this move to, 496, but then change that game plan mid-trade for whatever the reason is to liquidate at 596 at 590. Traders, and this is the worst problem that a trader can have, do that on the downside. They go, oh man, I was planning on risking to 582, and now when it's at 582.20, you're like, oh, you know what? 582, that was a bad stop loss. I'm going to give it to this pivot low here instead at 940. I'm going to give it down to 580, spot 84. I'm already, $3.50 out of the money. What's it matter if I give it another $1.50? And then, when you're getting close to this potential stop loss at 580.84, you say to yourself, oh, you know what? That's a bad stop loss too. I'm gonna use the low of the day. And at that point, then maybe you're saying to yourself, well, the low of the day here is 580.25, and the absolute low is 580, so I'll just give it to 580. So that's the worser problem to have, if worser is even a word. The other problem that can lead to not being successful in trading is not maximizing reward. And the way that traders not maximize reward is by getting out of their trades too early and not fully following on their game plan to get it. I am a big believer, especially when you're with trend on a trade, which you could argue, on the daily chart, maybe you're not with trend because this broke down on the daily post that earnings, but you're certainly on the trend on the small time frame, and you could also argue that you're on it on the big time frame because this thing broke out above 580, which, by the way, I would argue was your catalyst. It's a technical breakout. That is the catalyst. Traders are getting out of their trades too early as soon as they see some green on the screen. But there's a common saying in trading that I've disagreed with for years, and that saying is that you don't go broke taking profit. And I couldn't disagree with that more. I do think that you go broke taking profit. If every time a trader's $100 in the money, they liquidate their position and they take profit, that trader will never make $1,000. And if that trader, every time they're $100 in the money, is saying, hey, you don't go broke taking profit and liquidate their position because it's working, but then they let themselves lose $500 when the trade fails, then you're also looking at a trader that's not going to make money. So the bottom line on all of this, to circle back to everything, is that I think that game planning is one of the most important parts, maybe the most important part of trading. Because game planning is where you take your rules-based approach that is designed to be consistently profitable and apply it to any given trade that you take. And then game planning, I also think, is the ultimate counter to any negative psychology that any trader may have. You're the type of trader that, doesn't manage risk well. Well, guess what? Have a game plan for risk and follow it. You're the type of trader that doesn't maximize reward. Well, guess what? Have a game plan that maximizes reward and follow it. That is really what you need to do. So I'm a very big believer in, if you created a game plan for a particular trade, follow that game plan like to the death. And then maybe mid trade, you're like, oh man, I think I made some mistakes with my thought process with this game plan on this trade, whatever. I'm going to argue to you, don't change the game plan. Even if now you're in the trade and you get some new piece of evidence or some other information pops up that says to you, hey, maybe this was a bad trade, or maybe this is a bad game plan for this trade for the following reasons, I'm going to say to you, follow the game plan anyway. Even if now you think it's a bad game plan, follow the game plan anyway. Because if you don't follow your game plans, you're never going to be consistent. But then what you can do is, when the trade is over, then you can go back after the fact and assess whether or not the game plan was actually the right, appropriate game plan. If it was, repeat the process. If it wasn't, then adjust your game plans for similar trades going forward. So to circle back to your idea here, Vikas, if you're saying, hey, now I'm in the money 1-to-1 and I'm realizing, there was no catalyst for this trade, which, by the way, I would disagree with that. I do think that there was a technical catalyst. The technical catalyst, again, is the break of 580 that set off this gap fill work. But it doesn't matter, right? Regardless of whatever thought process goes through your head when you're actually taking the trade, that causes you to deviate from the actual game plan, don't deviate from the game plan. Just go back after the trade is fully finished and fully over and say to yourself, was my game plan correct to begin with? Should I not be getting involved in trades that don't have a catalyst if that is, part of what my edge is? So with all that said, I don't even think that was the real portion of your question. The real portion of your question, what you were trying to ask, I just thought it was really important to go over all that information, is, what could you have done to actually maximize reward and not get out, because you did get out and the thing just kept going and kept going and kept going, and guess what? It even eventually made it to your target. It's to implement a trailing stop system. I'm big believer in a trailing stop system for reward maximization. Be willing to give back some profit in order to make more. I have a class in my training program which you should have access to, which is the game planning class. I think it's one of the 2 most important classes of all the training program classes that I've done, and it gets into my system for trailing stops for reward maximization, where I have 3 rules: pivot low, ADMA catch up, new high. And if you followed that class, you could have raised your stop. This would be a really tight trail. But instead of just liquidating at 590, when it's at 590, your last pivot low reference, and you're still giving it back a decent amount, is 580.84, spot 71. And then eventually you get a pivot here at 587.64. The ADMA catches up to that. You get a new high, and you could eventually, probably sometime after 1030 or 1040, when it's now trading at 590, then raise your stop again to 587, spot 63. And if you continue to trail on a 5-minute chart, which is not something that I'm a big fan of, you could have trailed then to this low here at 1045, which is 589.02. And then you could have trailed eventually to this low, which is 589.35. Eventually could have trailed to this low, which is 590.25. Once you could trail to this low, 590.25, your worst case scenario is now getting out at the price that you actually got out at. Your best case scenario is that it keeps going. This is one of these super rare charts that I actually think holds a 5-minute trail all day. Yeah, look at that. You could have raised your stop to 590.41 at this time of the day. Then you could have raised your stop to 591.70. I'm really curious because now it's very rare. 591.78. Does that break here? 591.78? No, it holds. Holy cow. It's actually a perfect 5-minute trending chart. 591.86 is this low. You get a new high. You can raise your stop to 591.86 at the 120 low, and you can do that at 130. You get a pullback on the 5-minute chart to 592.90. Do you get a new high here? What's this high? 94.86. What was this high? It is a new high. Wow. So you can raise your stop again now to 590.92. Does that break here? Wow, they never break this. And then new highs come in. You can raise the stop. This is a rare chart, guys. This Netflix chart is a chart worth looking at. It happens sometimes. You don't see it happen very often, where you could have trailed on a 5-minute chart per my rules and held the stock for the entire day into the close. And I would have argued that then you should have swung it too. But yeah, it's pretty rare. It's really rare to see a 5-minute trend that lasts all day that doesn't break midday is usually when they break. And that's why you usually need to trail a little bit more on a 15-minute chart, which would require you to give back a little bit more profit potentially, but then you have a much higher probability of surviving midday chop and still having it for a potential afternoon rally into the close, which then has a higher probability of becoming a swing. The only other thing I would mention is, and this little bit, even with kind of the GameStop trade that I was in, with the game plan that I have for it, is I'm a big believer in being as greedy as you possibly can at a certain point on trades, because again, that goes back to risk reward. If every once in a while I can nab a trade where I make 100x my risk, think about what that does for me as far as a risk-reward basis, even for the rest of that month. How many trades? I have 100 trades just straight fail, and now I'm break even on my one trade that I made 100x on. And you can never know that this is going to be the trade that makes you 100x on. You just can have a game plan in place that'll get you there if that trade actually happens. So I'm a big fan of setting targets that seem impossible to reach and then reaching them every once in a while. And I'm also a big fan of trailing, and the more profit I have, the wider I can trail to be willing to risk more and more in order to make more and more. I love risking money that I've made in order to make more. I hate risking money in the first place. I hate the idea that I could have bought Netflix today and I just top ticked the thing and it comes down and stops me out and I lose my money. I hate that. But if I'm willing to risk $1,000 initially on that Netflix trade, I'm willing to risk of like actual money. I'm willing to risk $10,000 of open P&L because that's the only way that I can really turn that into significantly more and significantly more and significantly more. And my GameStop trade today, you know, we got in. I got in initially when this thing broke $14 when I was trying to buy it back through on the way up. There was very clear heavy seller at $14. I added a little bit into this downtick, and then I called out that you could really buy this thing potentially if the 14 breaks, and it did break, and it was a great move up. My game plan was to, you know, really sell the bulk of my position just with a small target of $15. But then I say to myself, you know what? I'm gonna give myself a target of 20 on my remaining stock. Seems crazy. It probably is a little crazy. You know, I'm talking about a $15 stock. I bought the thing below 14, and I want to see if I can get a $6 move out of it. That's a huge move. Granted, just the other day on Friday, it moved $5 to the upside all intraday, so we know that has the capacity to do it. I don't need the thing. I don't need the trade to work. I don't need the trade to work. I don't need it to go to $20. If I use today's day low as a stop loss, I will make money in this trade no matter what. And it's just going to be a matter of how much that I make. So at this point, now that I'm in that situation, sure, I covered the bulk of my position into that $15. But with this remainder of my position, why not be as greedy as absolutely possible? And honestly, the biggest thing that I'm thinking to myself when I kind of created the game plan for a move to 20 is I could be selling myself short. We're seeing calls go off in this thing at ridiculous prices. If I'm right on a TLT squeeze, I could be selling myself short. They could squeeze this thing up to $30 plus. You could squeeze this thing up to $35 plus. It sounds insane. It is probably a little insane, but guess what? That happens in the market sometimes. And I want to risk money that I've already made in order to potentially make more. So I'm a big believer in, you know, creating game plans, especially on anything that you do that is more with trend or with momentum, that can really maximize reward. You gotta take a bit of a half step back sometimes on the greed levels on things that are counter trend. If you decide to bottom pick that guild that we discussed earlier, the most likely thing when you look at a chart like this, and again I have a thesis in place where maybe this is different, but when you look at a chart like this, even if you can make money to the long side here or there at a certain point, you have to recognize that the highest probability situation is that your trade will inherently fail. And as a result, you want to have a game plan in place that books more profit faster and keeps a smaller percentage of your original position for the really big move. And from a percentage basis, you know, the amount of GameStop that I'm in for that bigger move, I still think is like 30% or so of the original position that I had. It's a significant amount. But GameStop right now, I'm with the trend, I'm with the momentum, I'm with the option flow. So why not? $20, let's go for it. Appreciate the question, Vikas. Appreciate you asking. From Barris in the VTF, can you please talk a little bit about gamma squeezes? Today there was a lot of July 19th $4 calls on Peloton. I noticed that there's a lot of open interest on July $4 and $6 calls. This was similar to 2 Fridays ago when we got a lot of bull flow in GameStop. I'm trying to understand when market makers hedge, that leads to the squeeze. Did they hedge immediately? Yeah, typically they hedge immediately. or do they hedge as it gets closer to expiration? They typically hedge immediately, but then just with the dynamic nature of options, it will oftentimes require them to adjust those hedges throughout the process of that trade in order to actually remain hedged with that position. If you are short calls from early last week in GameStop because you're a dealer and you had to come in on the other side, you were probably immediately buying the stock, and again, you will need to adjust that position. And the way they have to adjust those positions is gets a little complicated, starts to get on the edge of my knowledge and skill set, but you have all those different Greeks that affect the market in so many different ways, especially the options market. And in order to maintain a clean and clear hedge on a position, you potentially have to add or take off as time goes by, as volatility increases, decreases, as price changes. Um, so so that's kind of a little bit of a constant adjustment. But what we want to pay attention to with the options market is continuous flow, right? That's what made the GameStop flow. That's what made the GameStop flow initially notable, going back here on like April 24th and 25th. And I remember kicking myself just last week on Thursday, Friday. And look, like I say, they're not Pokemon. We can't catch them all. You can't capture every move in the market. But I was kicking myself a little bit Thursday and Friday that we had seen that options flow going off even earlier than Thursday in this initial up move, and seeing how it was dated and where it was priced for it. And I was kicking myself a little bit that I wasn't participating in GameStop a little bit, because the trade was there, the evidence was there, the flow was there, and the flow was consistent, and that's what we're looking for. And now we're seeing good consistent flow in Peloton. It doesn't seem to be huge or massive necessarily, but it's been pretty consistent. It's pretty dated. You're mentioning the July calls, but we also saw we saw some May calls, but we also saw a bunch of stuff that was dated even further than that. I think we saw September. I think we might have seen January 25 go off at one point today. So again, that has an immediate effect on the market, and a lot of times you can even see it, especially on like a thinner stock. You can see it sometimes immediately in like a 5-minute chart, where you just see that like kind of immediate uptick that comes in the stock. You'll see Pat just call it out, the flow, and you'll look and you'll see like 10 seconds ago there was a big uptick in the stock. And that's because at the time of the execution of those calls, the dealer on the other side was coming in and buying the underlying equity. As fast as Pat is, there's always going to be at least this lag of some seconds from the execution. So again, I don't think that you can really just like hyper scalp option flow because of that lag. But the consistent flow usually means that there's going to be even more flow coming also. Like, that was one thing I said, if you remember, when I bought GameStop today, I asked Pat, I was like, Pat, have we seen much flow in this GameStop yet? And he was like, nah, not much yet today. There was just one call that went off and it wasn't opening. And I was like, all right, I think my response was, all right, I need the sweeps to come in. Basically what I meant was I need that consistent flow that's already been coming in this thing to continue to come in. And if it's, I don't want to say likely, but it's more likely that you'll see more flow come into something that you've already seen consistent flow than you'll see more flow come into something where you just saw like a one-off call that actually occurred. So, and then all of a sudden, a little bit after, as this thing started breaking up, guess what? We started seeing the consistent GME flow coming in, which was squeezing this thing up and obviously, really helping my trade. So Peloton, I think, is a little bit different, but perhaps in some ways similar. I'm sure there's a decent short float in Peloton. I don't think it's massive. I think it's like 10 to 15%, something like that. So there is some decent short flow there. But every time someone comes in and buys those calls, then you've got the dealer that has to come in and come in on the stock on the other side. Probably has to buy even more for things that are more closer to expiration that are getting bought than things that are further out. A lot of this flow feels it is further out. So you've got the potential of it squeezing higher on that type of gamma squeeze. You got the potential of the short float causing it to squeeze higher a little bit. to me, this flow seems a little bit more of trader expectations of a buyout occurring than anything else because of the dating of it. The GameStop flow, correct me if I'm wrong, but I'm pretty sure that the GameStop flow has been primarily on dated that it's primarily been dated much closer in time to the Peloton flow that we've been seeing. So again, yeah, sure. Every time someone's buying some of those calls is probably helping a little bit of a squeeze in the market. It was funny. When I was trying to buy the Peloton September calls at one point today, I was trying not to pay the spread, and I was inside bid, but the market kept moving up, and I was like joining the market, and it was almost seemed like at a certain point it was like a chicken and an egg thing. I was like, is the market for these Peloton options that I'm trying to buy moving higher because Peloton's moving high, or is Peloton moving higher because the market for these options is moving higher? It almost felt that way to me. At a certain point, I stepped up inside bid a couple times actually to see if other calls would join my bid price, and they would. And that's how HFTs work, right? And you'll find that there can be points in time where don't do this if you don't actually want to buy the stock. But if you're like, I'm fine buying the stock, but I also don't need to buy the stock, instead of just taking the offer, if you got a wide spread, go inside bid, like go into the spread on the bid by 1 penny, and then watch all the robots join you, and all the liquidity step up, and then the robots might even start to chisel that liquidity. And then your stock almost kind of can begin to some degree to move into your favor because you started to bid up the stock a little bit without actually ever buying it, but it benefits your underlying position that you already have. Maybe I'm getting a little too out there for some of you guys, but you can certainly see that in the tape. So hope that helps your question, Boris, and I appreciate you asking it. Next in here from Jeremy. So why are you not a fan of trailing on the 5 minute? Because it almost always breaks. Why I ask is because I've been understand to not change your time frame of the trade. If you entered on a 1 minute chart, stay on a 1 minute chart, 5 minute to 5 minute, etc. Do you change your trade management to different time frames? So I agree and disagree with what you're saying here at the same time. I am a believer in not changing the game plan, like we were saying with Vicasa's question earlier, not changing the game plan of the trade when you're already in it. But I think that the game plan of the trade when you're already in it can incorporate multiple time frames, even if the execution is occurring on the 5 minute. And where I inherently disagree with you is because for me, every trade that I take is initially a multiple time frame trade before I got in it. Like I was again saying with Vicasa's question, the daily chart tells me what I want to buy, but a 5 minute chart or a 15-minute chart tells me how I want to buy it. Well, that inherently means that even if I'm executing on the 5 minute, I'm doing it because of the daily chart. I'm trading on multiple time frames. So is my trade management now based on a 5 minute chart, or is it based on the daily chart? So I think that you can execute based on a 5 minute chart, but then you can say to yourself, hey, on X percentage of my position, I am going to trail it only based on a 15-minute chart, which means that you are leaving your stop loss in at the original stop loss until and unless that percentage of your position can meet your rules for actually trailing on a 15. And now all of a sudden you could have a trade where, yeah, maybe your entry execution was based on 5 minute, but you are, you're trailing some on that 5 minute chart, which again, if you are trailing on a 5 minute chart, that Netflix example is a very rare example. If you're trailing on a 5 minute chart, you are almost guaranteeing to yourself that you will get stopped out at some point during the day. And guess what? Sometimes that's fine. Because if you're trailing on a 5 minute chart, you're trailing really tight, and you're saying, you know what, I want to be conservative and I want to lock in profit. If you're trailing on a 15-minute chart, or the longer the time frame that you trail on, 5 to 15, 15 to hour to day, whatever, the longer the time frame that you're trailing on, the more that you're willing to give stock back in order to potentially make more, but also therefore the lower the probability is of you getting shaken out or pushed out of a trade that actually continues in your direction. So I'm not a fan of trailing on a 5-minute chart because when it goes back to a reward maximization perspective, I know that I will never fully maximize reward and will never fully capture moves if all I do is trail on a 5-minute chart. Which isn't to say that I don't fully hate trailing on 5-minute charts or that I don't do it myself. It just goes back to what I just said, which is if I am trailing on a 5-minute chart, I am inherently going to get myself stopped out during the day, and I might be fine with that because I want to be conservative and I want to lock in P&L, and that can be just fine. So again, to circle back on what you're saying, I agree with you and I disagree with you, kind of both at the same time. I don't think that you should trade your trade management in the trade after you're already in the trade to different time frames, but I think that your trade management or your game plan should probably, not always, but probably most of the time, be incorporating multiple time frames to begin with, because all trades that you enter need to be thinking about multiple time frames as you enter them, even if the specifics of the execution when you're first getting in is based on a 5-minute chart. I hope that helps. Let me read your follow-up. I understand multi-time frame alignment and finding tradable moments on one time frame, but that may not be noticeable in another. Just wanted to know if changing management from one to the other is okay. Yeah, I think I answered the question. The only thing I would say, because you mentioned a 1-minute chart, I forgot that Vikas mentioned a 1-minute chart. I hate 1-minute charts. 1-minute charts suck. Sorry, I'm just gonna go ahead and say it. The time frame is just too small to get any information that's actually pertinent, I think, from an execution perspective, or let alone a idea perspective, which the idea stuff should primarily be coming from daily charts, maybe even weekly charts. And I think that the execution at a minimum should be coming off a 5-minute chart. There's never really a time frame when a 1-minute chart is I think, appropriate from an execution perspective if you actually want your trades to be able to maximize reward with doing your best to limiting the probability of shakeouts actually occurring. And at that point, you might as well just be tape reading anyway. Cool. All right, popping over into YouTube. What's up, Mike? Appreciate the kind words from Gabriel. Seeing more stocks setting up recently in the past couple of days, like ASPN, GPMC, and Kava. ASPN, just getting way too extended here for me on that one. I need to reset up. BPMC. This one isn't maybe in the process of setting up now, but there is still some extension. Kava. Don't love that shooting star. I also think this one needs to reset up. So you like them on low volume pullbacks. Yeah, you need some sort of executable setup there. The daily charts all look fine. They're just all a bit extended. You also think that PSTG Pure Storage looks decent for the week. I like this. 54 is a breakout level for this thing. Can definitely be on the radar for tomorrow. And NTNX. This looks good too. 64 was a bit of a level. It broke today. 66 is another level. So yeah, worth having these ones on the radar. If any traders are following along, you might want to have some alerts out. Some good ideas here. I'm putting an alert out for that NTNX. Cool. CEG and VST are also interesting as AI will bring more energy consumption. Oh, this is that Goldman play that we had got brought up the other day. This chart looks phenomenal. Above this 196 to 200 area. CEG. It started today. It's a little bit extended. But the chart looks phenomenal. It's another one that we should keep on our radar. VST looks a little extended to me. Might need to reset up. Microsoft invested in solar and wind energy recently to power themselves. I didn't see that. It's cool information. Would you like a couple days of pullback after today? What I would really like is a couple days of sideways action. It would make for boring trading, but I would love for the market to consolidate above 515. Even if it breaches it a little bit, fine. But I'd love for the market to stay above 515 because that's our confirmation level. and let the moving averages catch up. A price correction wouldn't be the end of the world. You know, it wouldn't necessarily be unhealthy for us to retest 511, and that could potentially be viable. But then once we're back below 515, we're going to be like, oh, do we have the actual confirmation? You know, blah, blah, blah. So 511 maybe for a retest could be viable. But in a more ideal world as a bull, I'd like a consolidation above 515. I'm just reading the rest of your question. Yep, exactly. Jeremy likes the food at Kava. I think it's all right. It's not as good as Naya Express, but we can't trade that one. So Kava it is. All right, gang. 5:20. We had a good long afternoon meeting. Why was it a good long afternoon meeting? It's because you guys brought some great questions to the table today, and it gave us something to really review. So appreciate you guys for making this a really good afternoon meeting. We were able to dive into some good stuff there. If you're on YouTube, press the thumbs up button for me. And everyone have a wonderful night. I'll see you tomorrow.